Remember the panic of 2008? The long lines, the frozen accounts, the fear? It might not be a distant memory, as some experts are predicting a major bank collapse could be brewing in 2024. But why? Imagine this. Businesses struggle to repay loans as interest rates skyrocket. At the same time, empty office buildings leave commercial real estate loans sour. With mounting losses, banks could teeter, potentially sparking a domino effect throughout the financial system. Is this a guaranteed doomsday scenario? Not necessarily. However, understanding the potential risks can help you navigate the coming months with a clear head and informed decisions. In 2023, a string of bank failures severely impacted the US economy, causing significant distress. Particularly alarming were the collapse of two prominent US banks, which had far-reaching effects throughout the financial sector. The housing market, already fragile, was especially susceptible to these bank failures, bringing back memories of the 2008 financial crisis when numerous banks struggled. The recent crises are reminiscent of those times, with around 90% of banks now teetering on the brink of collapse. Should this occur, the repercussions would be felt by all. The impending banking crisis stems from several factors, notably the gradual increase in defaults on commercial real estate loans held by US banks. Coupled with rising inflation figures, this paints a worrying picture. Predictably, the Federal Reserve is likely to maintain current interest rates, possibly even prolonging them. There's even speculation of a rate cut in June, although the potential consequences of such actions are uncertain. A recent study highlighted the precarious position of 186 US banks, attributing their fragility to factors like rising interest rates and a significant portion of uninsured deposits. This vulnerability is particularly evident among banks heavily reliant on uninsured depositors, especially those with accounts exceeding $250,000. The current economic climate, with increasing inflation rates, sets the stage for a major credit event. The situation is compounded by declining commercial property values and a surge in bad loans. With over $900 billion in debt on U.S. commercial and multifamily real estate needing refinancing, the situation is precarious. High vacancy rates and persistently high interest rates further exacerbate the challenge, especially for smaller institutions. With such a massive exposure, any trouble in the market could lead to disaster, and unfortunately, it seems like there's trouble brewing. According to Marathon Asset Management, these smaller banks are facing a worrying 8 to 10% default rate in their commercial real estate loan portfolios. That's billions of dollars in loans at risk of being written off. However, these defaults could impact not only the banks, but also the wider economy. According to a recent report, if just half of uninsured depositors decided to withdraw their money from these 186 at-risk banks, it could spell trouble for everyone, even those with insured deposits. Because if the banks lack sufficient assets to cover all the withdrawals, it could result in losses for everyone involved. The Federal Deposit Insurance Corporation might need to intervene to clean up the mess. This raises significant questions. How might such a scenario affect the stability of the banking system, and what steps should be taken to prevent such a crisis? The demise of Silicon Valley Bank serves as a stark reminder of the risks associated with rising interest rates and uninsured deposits. As interest rates began to rise, the value of the bank's assets declined, and anxious customers started withdrawing their uninsured deposits. This double blow left the bank unable to meet its commitment to depositors, ultimately leading to its collapse. This prompts us to ask, what lessons can we learn from this unfortunate series of events, and how can other banks protect themselves against similar risks in the future? The report suggests that even if only half of uninsured depositors decide to withdraw, nearly 190 banks are potentially at risk of causing losses for uninsured depositors, putting approximately $300 billion of insured deposits at risk if uninsured deposits are withdrawn. Withdrawals of deposits lead to significant sales, putting more banks at risk. Economists conducting the study warned that these 186 banks could face a similar fate without government help or recapitalization. What measures should banks take to endure rising interest rates and customer withdrawals? Meanwhile, a recent research paper delved into the overall health of U.S. banks and the fragility of the banking system. According to the paper, a 10% default rate would mean around $80 billion in additional losses for banks. But here's the kicker. Commercial real estate loans, comprising about a quarter of an average bank's assets and totaling about $2.7 trillion in the aggregate, are facing challenges. With property values declining due to high interest rates and remote work setups, around 14% of loans overall and a staggering 44% in the office sector are now underwater. And that's not all. Following the monetary tightening of 2022, Banks collectively experienced a $2 trillion drop in asset values. Additionally, 231 banks with a combined asset value of $1 trillion are now confronting the unsettling reality of their assets being worth less than their non-equity liabilities. What implications do these numbers hold for the banking sector and the economy? Essentially, the drop in commercial real estate values is leaving borrowers unable to refinance quickly, potentially rendering over 300 smaller regional banks insolvent. Looking ahead, when banks release their quarterly reports after the first quarter, significant changes are expected. Bad loan reserves are anticipated to be much higher, and lending may slow down as banks focus on bolstering reserves. However, even with these increased reserves, it's uncertain if banks will have enough to cover their bad real estate loans. Over the years, we've observed a consistent decrease in the number of FDIC-insured institutions listed as problem banks. Let's take a look at the numbers. In 2012, there were 651 problem banks. Fast forward to 2021, and that figure dropped significantly to just 44. This marked decline indicates a positive trend for both the banking industry and the broader economy. Looking ahead to 2022, this downward trend continued, with the number of problem banks further reducing to 39 by the year's end. Now, what's driving this decline in problem banks, and how might this trend affect the financial landscape moving forward? According to reports from the FDIC, the diminishing number of problem banks, reaching a mere 39 by the end of 2022, holds significant importance. It signals stability and resilience within the banking industry despite facing various economic challenges. The declining trend in problem banks underscores the effectiveness of regulatory measures in ensuring the safety and stability of the financial system. However, despite the positive outlook portrayed by the FDIC reports, the Financial Times has reported alarming news. Bad commercial real estate loans have surpassed loss reserves at the largest U.S. banks following a substantial increase in late payments associated with offices, shopping centers, and other properties. This sharp deterioration occurred within the last year, with delinquent commercial property debt for the 6 major banks nearly tripling to $9.3 billion. An illustrative example of this is the comparison of loan reserves to delinquent loans in 2022 versus 2023 for the largest U.S. banks. The situation appears dire. Global asset managers have advised their clients to limit exposure to U.S. commercial real estate portfolios, signaling anticipation of a potential crisis. For instance, a German bank has openly warned of the most significant real estate crisis since the 2008 financial crisis, with fears spreading to Germany. In anticipation of the looming bank crisis, banks must prioritize prudent risk management and diversify their funding sources to ensure stability amidst market fluctuations. It's crucial to navigate these challenges with careful consideration, especially when faced with market volatility. In navigating today's dynamic market environment, banks must implement strategic measures to manage risks effectively and ensure stability. The looming specter of rising interest rates, coupled with the challenges posed by uninsured deposits, requires proactive risk mitigation strategies. The cautionary tale of Silicon Valley Bank's failure underscores the importance of preemptive action in safeguarding the banking industry. To address these challenges, banks should prioritize enhancing risk management practices. This entails a thorough assessment and mitigation of potential threats posed by factors such as uninsured deposits and fluctuating interest rates. Additionally, stakeholders involved in buying and selling banking assets must navigate these complexities with prudence and foresight. The potential ramifications of the failure of 186 banks, as highlighted in the report, are profound. The implications extend beyond individual institutions to encompass the broader economy. A cascade of bank failures could trigger a domino effect, leading to a credit crunch that impedes access to credit for businesses and consumers, thereby stifling economic growth. The global economic landscape is currently facing a multitude of challenges, each exerting significant strain on U.S. banks and contributing to a climate of uncertainty and instability. One such challenge is the emergence of a global recession, which has been exacerbated by various factors, including the ongoing conflict in Ukraine and the Middle East. These geopolitical tensions have disrupted global trade and investment flows, leading to reduced economic activity and adversely impacting the financial health of banks worldwide. Furthermore, the United Kingdom's economy has entered a recession, driven primarily by the economic disruptions caused by Brexit and exacerbated by the COVID-19 pandemic. The uncertainty surrounding Brexit negotiations has weighed heavily on business confidence and investment decisions, leading to a contraction in economic output. As one of the U.S.'s major trading partners, the U.K.'s recession has ripple effects on the global economy, further straining U.S. banks' ability to navigate turbulent financial waters. Similarly, Germany, typically regarded as the economic powerhouse of Europe, is facing economic challenges of its own. Despite being one of the most developed economies, Germany's economy has experienced sluggish growth in recent years due to structural issues and a slowdown in global demand. The economic woes in Germany have reverberated across the Eurozone, adding to the headwinds faced by US banks operating in the region and amplifying the challenges posed by the global economic downturn. Adding to these external pressures is the performance of the Democratic Party in the United States, which has been under scrutiny for its handling of economic policies. While the Democrats have implemented various measures to stimulate economic growth, such as fiscal stimulus packages and infrastructure investment, their effectiveness has been called into question amidst rising inflation and concerns over fiscal sustainability. The lack of consensus on key economic issues has further contributed to market volatility and investor uncertainty, tarnishing Wall Street's reputation as a stable and reliable financial hub. Given the gravity of these risks, proactive intervention by regulatory authorities may be necessary to prevent a systemic crisis. Swift action is essential to fortifying the resilience of the financial system and mitigate the adverse effects of potential bank failures. Moreover, addressing vulnerabilities in these identified institutions is paramount to averting a broader crisis scenario. The interconnected nature of the banking system means that the failure of one institution could precipitate a chain reaction, eroding confidence and triggering widespread panic. Such a scenario could precipitate a recession or even a full-blown financial crisis. Therefore, bolstering confidence and maintaining stability in the banking sector is imperative to safeguarding the overall economic health. The specter of bank failures underscores the importance of proactive risk management and regulatory intervention. Stakeholders must remain vigilant and collaborative in navigating these challenges to ensure the stability and resilience of the banking sector. Your insights on this critical issue are invaluable, so we invite you to share your thoughts in the comments section. And don't forget to subscribe for more insightful discussions on key economic topics. We'll see you in the next video.